$3.1 billion. Let that sink in for a second. That is the massive top-line revenue figure STMicroelectronics generated in just the first quarter of 2026 alone. Right out of the gate, this single number establishes ST as an absolute powerhouse in the global semiconductor landscape. I mean, they are navigating this really complex macroeconomic environment and still pulling in immense capital. But as we know, a single number never tells the whole story, does it?
So welcome to this explainer of ST Microelectronics Q1 2026 earnings report. We're going to unpack the massive revenue engine actually driving that $3 billion figure and take a really close look at the strategic investments that are shaping their future right now. Today, we're jumping straight into the hard data from their financial release to figure out exactly how this tech giant is positioning itself for what could be the next decade of silicon dominance.
To make sense of all this dense financial data, we've broken it down into 4 straightforward parts. Number 1, the Q1 headline numbers. Number 2, strategic partnerships and acquisitions. Number 3, decoding the cash flow. And finally, number 4, guidance and sustainability goals. All right, let's jump right into part 1, the Q1 headline numbers. Now, breaking down their overall year-over-year revenue growth tells a pretty wild story. Just look at the communications equipment and computer peripheral sector, or CECP. They posted these massive 41% year-over-year gains. It's a crystal clear indicator of the booming infrastructure required for our increasingly connected world. And the rest of the board is no slouch either. Industrial followed with a very strong 26% growth, personal electronics hit 21%, and automotive rounded it out at 15%. So across the board, compared to this exact time last year, ST is seeing double-digit expansion in literally all its core markets. But hey, we got to keep a balanced perspective here. While they did achieve an exceptional 23% overall year-over-year growth, they also saw a 7% sequential drop from Q4 of 2025. Now, you might be thinking, uh-oh, but a post-holiday dip is incredibly common in the semiconductor world. The real takeaway here, despite that 7% drop, their performance was actually 170 basis points better than the midpoint of ST's own guidance. They actually anticipated a larger dip, and their engine just completely outperformed those expectations. Moving right along to part 2, strategic partnerships and acquisitions. Okay, so ST is making this absolutely massive push into cloud infrastructure. They've just announced a multi-year, multi-billion-dollar commercial engagement with none other than Amazon Web Services. They're teaming up to build high-performance compute infrastructure for cloud and AI data centers. To do this, ST is leveraging its proprietary tech, specifically their 800-volt power conversion technology, along with new 12-volt and 6-volt architectures to make these data centers just incredibly efficient. And this partnership is so deep that ST has actually issued warrants to AWS for up to 24.8 million ordinary shares. Basically, they're tying AWS's financial interests directly to the adoption of ST products. It's a brilliant move. But listen, they aren't just looking up at the cloud, right? They're locking down their foothold right at the edge with personal electronics and robotics. Their core wireless and motion sensing tech is currently being integrated into Qualcomm's Snapdragon Wear Elite platform, which is directly targeting the wearable market. And concurrently, they are partnering up with NVIDIA to accelerate physical AI development. By embedding themselves with these other massive tech titans, ST is practically ensuring its silicon becomes the foundational layer for the next entire generation of smart devices. And then there's the industrial side of things, where ST is really flexing its global manufacturing muscles. They've successfully delivered the very first batch of their widely popular STM32 microcontrollers produced entirely in China by their foundry partner, Huahong. Now, localizing manufacturing specifically for the Chinese market is honestly a masterstroke in supply chain resilience. When you see moves like this, it's completely unsurprising that, according to Omdia, ST was ranked the #1 vendor worldwide in general-purpose microcontrollers for the 5th consecutive year. All right, let's turn to part 3, decoding the cash flow. Now, at first glance, hearing about a negative $723 million free cash flow, yeah, it's a little jarring. It seems pretty alarming for a highly profitable company that literally just reported over $3 billion in revenue, right? Especially when you consider that in the exact same quarter last year, they had a positive free cash flow of $30 million. So this obviously begs the question, where in the world did all that cash actually go? Did their operations just suddenly become a massive drain? Well, the answer lies in another completely massive number. An $895 million cash out executed back in February of this year. Actually, scratch that initial panic because this $895 million wasn't some kind of operational loss. It was a highly strategic payout. ST officially completed the purchase of NXP's MEMS sensor business. This specific transaction aggressively expands their capabilities in automotive safety products and industrial sensors. So, yeah, it temporarily pushed their free cash flow into the red, but it was a deliberate cash-funded maneuver to buy high-value intellectual property and grab more market share. And if you actually exclude this one-time mega purchase, their underlying financial position remains rock solid, sitting on over $4.5 billion in total liquidity. Which brings us to our final section, Part 4, Guidance and Sustainability Goals. Looking ahead to Q2, the crucial point here is their absolute confidence in a rebound. They are projecting net revenues to hit $3.45 billion at the midpoint. That is a very healthy 11.6% sequential bump from Q1 and a near 25% leap year over year. Plus, they expect their gross margin to hold really strong at around 34.8%. Basically, this tells us that the demand for their semiconductors isn't just stabilizing, it's actively accelerating as we push deeper into 2026. And what's really cool is that their financial targets are running perfectly parallel to their environmental ones. Now, we all know semiconductor manufacturing is incredibly resource intensive, but ST has committed to a very strict timeline here. After hitting 86% renewable electricity last year, they are now aiming for 100% renewable energy sourcing by the end of 2027. And even more impressively, they plan to reach carbon neutral status on Scope 1 and 2 emissions by that exact same year. They are literally proving that massive industrial scaling doesn't have to come at the expense of sustainability. To sum up this whole trajectory, CEO Jean-Marc Chery basically hit the nail on the head. He stated, ST is now strategically positioned to capture upside from new AI-driven programs. He pointed out that this rapidly evolving AI infrastructure is exactly what gives them the confidence to confirm their data center revenue will sit nicely above $500 million this year and then scale well above $1 billion by 2027. You remember that massive AWS partnership we discussed earlier? Yeah, that is the exact revenue pipeline it's meant to fill. So as we wrap up this explainer, we really have to step back and look at the whole chessboard ST has set up. On one side, you have multi-billion-dollar cloud data center deals. On the other, massive near-billion-dollar automotive sensor acquisitions. They are betting heavily on two very different futures at the exact same time. So what do you think? Which of these aggressive expansion moves will ultimately define ST's next decade of dominance? Will it be the AI data centers powering the cloud, or the sensors driving our autonomous vehicles? It is a fascinating question to ponder as we watch this tech giant execute its strategy. Thanks so much for joining me, and keep your eyes on the data.